Why should we invest? Before we address the above question, let us understand what would happen if one chooses not to invest. Assume you earn rupees 50,000 per month, and you spend rupees 30,000 towards your day-to-day living. This can include expenses like housing, food, transport, shopping, medical, etc. The balance of rupees 20,000 is your monthly surplus. For the sake of simplicity, let us ignore the tax effect in this discussion. To drive the point across, let us make a few simple assumptions. 1. The employer is kind enough to give you a 10% salary hike every year. 2. The cost of living is likely to go up by 8% yearly. 3. You are 30 years old and plan to retire at 50. This translates to 20 working years. 4. You don't intend to work after you retire. 5. Your expenses are fixed and you don't foresee any other expenses. 6. The balance cash of rupees 20,000 per month is retained as hard cash. Going by these assumptions, here is what the cash balance will look like in 20 years. After 20 years of hard work, you have accumulated rupees 1.7 crores. If one were to analyze these numbers, one would soon realize this situation is scary. After you retire, assuming the expenses will continue to grow at 8%, the retirement corpus of rupees 1.7 crores is good enough to sail you through roughly 8 years of post-retirement life. 8th year onwards, you will be in a tight spot with literally no savings left to back you up. What would you do after you run out of money in 8 years? How do you fund your life? Let's consider another scenario where instead of keeping the cash idle, you choose to invest the cash in an investment option that grows at, let's say, 12% per annum. For example, in the first year, you retained rupees 240,000, which when invested at 12% per annum for 20 years, 19 years assuming you invest at the end of first year, yields rupees 267,063 at the end of the 20th year. Here is how the table looks if you choose to invest. Your cash balance has increased significantly with the decision to invest surplus cash. The cash balance has grown to rupees 4.26 crores from rupees 1.7 crores, a staggering 2.4x more than earlier, when you choose not to invest. Clearly, with the decision to invest, you are in a much better situation to deal with your post-retirement life. Now, going back to the initial question of why invest, there are 2 compelling reasons. 1. Fight inflation. By investing, one can deal better with the inevitable reality of life, the growing cost of living, generally referred to as inflation. 2. Create wealth. By investing, one can build a bigger corpus by the end of the target period. The decision is yours now. Subscribe for more videos like this.